Floor show. We've got Thomas H. Lee Partners co-CEO Scott Sperling and Euro-Pacific Asset Management Chief Economist and Market Strategist Peter Schiff. Peter, I want to start with you on the gold story because we saw fresh highs being hit throughout the news conference from Jay Powell. What do you make of those moves?
Well, I expect that to continue. You know, the Federal Reserve created an enormous inflation problem. Current monetary policy is still way too loose. They aborted the hiking prematurely. Rates need to be a lot higher than they are right now. And look, the economy is weak. I think we're in recession. I think we've been in a recession for quite some time. That's why Donald Trump was elected president. But unfortunately, that recession is going to have to get a lot worse to put the inflation genie that the Fed deliberately released back in that bottle. But it's not going to happen. You know, Powell was lying when he said that long-term inflation expectations remain anchored at 2%. I think last week we got the March consumer sentiment, which showed that a 5-year inflation expectation spiked to 3.9. That's the highest in over 30 years. And consumers are wrong because inflation is going to be a lot higher than 3.9% on average over the next 5 years.
And you know, look, if you do see these tariffs really go through, and on a positive, I guess that gives businesses uncertainty. On a negative, that, Scott, can be a real tough effect on the U.S. economy. You know, we went into this year, Scott, kind of on the assumption that the president was using tariffs as a negotiating tool, but not so much anymore. He's been very clear.
Yeah, I think it's more than that.
Yeah, go ahead.
Yes. No, I think it's more than that. And I think that there are a couple of reasons for that. You know, obviously, he's been using it to negotiate or renegotiate agreements that already exist. We have a second layer, though, which is the reciprocal tariffs, which is to say whatever someone else is doing, we should do the same thing. Either way, that will raise the tariff. And then the third is a long-term push to bring not just manufacturing, but manufacturing of a broad range of things that we had thought we let go to other parts of the globe back to the United States, not for as much for economic reasons as for national security reasons. So aluminum, steel, shipbuilding, you know, there's no great economic reason to bring them back, but they're, I think, in the view of the administration, strong national security reasons. So those forces may be stronger than the original thought, as you noted, which is, oh, they're never going to be real because it's just going to be part of a negotiation. So I think we have that to look at. The economy, and I would agree with Peter, that I think the Fed is understating in the comments, though not their actions, the threat of longer, stronger inflation. And the risk to the overall economy is about as high as we've seen in the last 18 months. So I think all of those things play together to create uncertainty. If you don't know what your input costs are going to be because you need something that may be subject to a significant tariff, then it's very hard for you to decide what to invest in or what you may want to buy if you're looking at an acquisition as a company.
Yeah.
So all of these things will work together to potentially slow the economy. And I also think Peter is right. Most of the friends I have who are CEOs of industrial or manufacturing companies will say that we're already in a recession or we have been in a recession for the last 24 to 36 months.
That's interesting.
So I think there's a lot out there. The flip side, obviously, is enormous productivity gain potential through the use of generative AI. It's the reason that you see the Mag 7, or at least 6 of the Mag 7, move up the way that they have. And I think we also can't read exactly how powerful that counter and very productive trend could be over the course of the next 12 months. But I think over the course of 24 to 36 months, it's going to be an incredibly powerful force.
Right. I've got about 10 seconds, Peter Schiff. Giving you last word.
Well, look, I think productivity can offset some of the damage that the Fed has created by expanding the money supply to the degree that it did both with the first 3 rounds of quantitative easing and then during COVID. We still haven't felt all the consequences on consumer prices from the inflation the Fed created in the past, but they're continuing to create more inflation. Credit has expanded the entire time that they were supposedly hiking rates, so it was too little too late. We've had a brief reprieve, but the numbers are headed much higher. We're going to take out 9%. That peak that we had in 2021, 2022, that's not the high for this inflationary environment that we're in. We're going much higher. This is a lot worse than the 1970s, and the economy is in much worse shape now than it was then.
Peter, give me a number then.
Well, I hope not.
What do you? I know. I hope not too. But Peter, give me a number.
It's going to be in the double digits, and I'm not even sure what the first digit's going to be.
Okay.
By the time it peaks.
Yeah, well, that's, well, hopefully Powell is ready to act if that happens. Peter Schiff, Scott Sperling, guys, thank you so much. It's great to see